Hi, my name is Ed Rieu. I'm a partner with Blick Rothenberg's US-UK tax practice. I deal mainly in corporation, partnership, and trusts for high net worth and individuals and entrepreneurs. Today we're going to talk about the family home in divorces. It's one of the main assets, and that will include a divorce of married couples and couples in a civil partnership. I'm joined today by my partner, Suzanne Briggs.
Thanks, Ed. So I'm Suzanne Briggs. I'm a partner in the private client team at Blick Rothenberg, looking after UK high net worth individuals and their personal tax affairs.
So what we're going to talk about today is the family home and a financial settlement in a divorce. It's one of the major assets that families normally have, and there's a host of issues that arise where there's an American involved in the divorce. So Suzanne, what are the things that we need to be thinking about from a UK perspective when we're dealing with the principal residence and whether we sell it or transfer it or have one of the parties live in it as part of a financial settlement?
So in the UK, under UK taxation principles, a married couple have one main residence between them, and main residence relief acts to exempt all or part of the gain that arises on the sale of the main residence, provided it's been occupied as the main residence throughout the period of ownership. In the context of divorce, this can get a little bit more complicated, where one of the parties to the divorce perhaps moves out, or as you say, the property is sold.
Is there a period of time where the parties have to be together? In other words, if one party leaves, how long after they leave does it become an issue?
Yes, a really good question, Ed. So where you've got a property which qualifies for main residence relief, the final 9 months of ownership always qualifies as a period of deemed occupation for capital gains tax purposes. So obviously this can give rise to problems in the context of a separation or divorce. So one of the parties moves out and they've moved out of the property for more than 9 months. Fortunately, in 2023, the legislation was improved in this area so that main residence relief can be available to what we call the departing spouse in the context of main residence relief. So this has two effects. So where the property has been ordered to be sold to a third party, provided that the remaining spouse lives in the property as their main residence, the departing spouse can claim main residence relief on their share of the capital gain. The downside is that they can't have main residence relief running at the same time on another property, so you have to look at the pros and cons. Another situation where main residence might be available is in the context of deferred charge orders. So where the court orders that the house will be sold at a later date and the proceeds divided amongst the parties, main residence relief can be available to the spouse who has left the property, even though he no longer or she no longer lives in the property as their main residence.
So just to cover off, if there's an American transferring to a non-American, and they're transferring their interest, that's a gain transaction. If it's an American to an American, there's no gain or loss from a U.S. perspective. Where there is a gain in its principal residence, the U.S. allows for a $250,000 exemption, provided that the U.S. person disposing of the property by sale or transfer to a non-U.S. person has lived in the property for 2 of the 5 years leading up to the year of sale or transfer. So it's not so generous as it is in the UK. And it gets worse because Americans are dollar-based. From a US perspective, they have to report everything in dollars. And so that means that where they buy something in sterling, they have to convert that purchase price into dollars. Then when they sell it, they have to convert the sale proceeds into dollars. And that difference is gain from a US perspective, if it is a gain. That means that if you have a 100,000 purchase and 100,000 sale, but the dollar, there's a movement in the dollar where you can end up with a foreign exchange gain. That can be an issue, an uneconomic issue, but an issue nonetheless. And in addition, with a mortgage, it's the same applies, where a person borrows a certain amount in sterling. When they go to redeem that mortgage, if the dollar is strengthened, it takes less sterling to pay it off. You'll have a foreign exchange gain. So that can be a problem as well.
So I think what you're trying to say is that even if a property might be exempt from capital gains tax in the UK, if it's a UK property, there can still be US tax considerations.
And that's the issue, because now you have a no gain or loss, no tax in the UK, but a gain in the US and tax to be paid. And then you have to look at what's the foreign tax credit position and whether or not excess foreign tax credits that might be with that US person can be used to offset that. That's an analysis that would depend on who the advisor is. There are certain positions that people take and other people don't take. So I think that pretty much covers what we wanted to do, go over today with respect to the principal residence in a financial settlement in divorce. We trust this was useful. If you have any further questions or you want to contact us, please do so through our website.